Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about net liquidity within the context of the S&P 500. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. I will remind you that we did a video on net liquidity a few weeks ago where we talked quite extensively about different versions of net liquidity and how you can come up with net liquidity. I will link that video in the description below in case you missed it and you want to go check it out. Just to give a brief summary, the way that we're calculating net liquidity here is just simply adding up the balance sheet of various central banks. We're looking at the United States, the ECB, Canada, the UK, China, Japan, Australia, and New Zealand, and we're subtracting out the TGA and the reverse repo. And then when we do that, we get something that looks like this, which is the yellow line you see on the bottom half of the screen. Now, if we overlay this with the S&P 500 at the top, you can see that there are at times very strong correlations, but then at other times we see a divergence where the jaws open up. I wanted to explore this further than we did in the previous video, so we will be covering something that's a little bit new. One thing you should note is that in March, we saw the jaws open up between the S&P 500 and net liquidity. And the question is, well, has this previously happened? And of course, the answer is yes. We can see that back in 2018, we saw the jaws open up and it took them approximately 30 weeks or so to clamp shut. And in 2019, we saw the jaws open up and it took really over a year for them to clamp shut. If I were just sort of take a date range here, you can see this was about 30 weeks or so, and then from these levels back over here, it was about 60 weeks before the jaws clamped shut. So it's not different from what we've previously seen, and so far we could argue that the jaws opened up about 16, 17 weeks ago. So one thing that history shows us is that eventually the jaws clamp shut. It's just hard to know exactly how long that will take to achieve. Remember, in pre-election years, we actually often see the S&P climb the wall of worry. This is not something that's that new. It's something that we've historically seen, and maybe we can cover that a little bit later on in the video, but if I remember. But the interesting thing is, well, why not quantify this relationship here? Rather than just sort of overlay it, why not take the S&P 500 and divide it by net liquidity? Now, I also divided it by a really large number as well, just to get numerical values that made a little bit more sense. But what you should look at is not the y-axis, but just the qualitative trend. Just look at what's going on when you take the S&P 500 and you divide it by net liquidity. What you will in fact see is perhaps a fairly well-defined parallel channel. It's not perfect, but I mean, you can see generally speaking that this is an upward trend. And you'll also see that there have been times where we come up to the top of this channel only to get rejected for a while. Right? You can see that occurred back in 2010. It occurred back in 2015. We also temporarily got rejected in 2019, but then we saw an excursion by this relationship much higher up before it crashed to the bottom of the channel. You can also see that we were in this sort of the bottom of the channel back over here during the financial crisis back in 2009. But what I find interesting in this case is that over the last 10 years, there's really only been one time where we saw it diverge from this somewhat well-defined parallel channel, and it was back over here in 2019. So then it got me thinking, well, what are similarities today and in 2019? Well, it's a pre-election year, right? So we do have elections next year. We are watching the S&P slowly go higher, which is what it typically does in pre-election years. However, there are some pre-election years or early phases of the election year where we've seen a recession kick in, and then therefore those gains can get wiped out, as we saw back in 2020 when we had the pandemic. And arguably, you could say that it was a black swan and that the inverted yield curve of 2019 had nothing to do with it. A counterpoint is to say that an inverted yield curve tells you that the economy is sick and that it only takes one more thing to really make the S&P or make the economy go into a recession. Of course, by association, the S&P could drop in it by association with that. But when you look at this, right, there's one prior time here where we saw this relationship go way up here, and we're now entering into that territory today, and it was back in 2019. And what's interesting, right, you can see we entered it in late 2019. What's interesting is if you look at, say, this treasury yield spreads between the 3-month and the 10-year yield, we saw an inverted yield curve back in 2019, right? I mean, you can see we were inverted in September of 2019 and August and July of 2019, again, the pre-election year, just as it's inverted today. And in the same way, we saw this relationship go all the way up to the top part of this channel. Now, it hasn't reached it yet, and of course, this does not make a trend. It's just a single data point. If you were to draw a horizontal line across, you can see that the divergence between the S&P 500 today and net liquidity is actually higher than it was back then, right? I mean, you can see this relationship is all the way, just the numerical value that I have over here is about 1,700, and you can see the highest one back over here was in sort of the mid 1600s. So the extension has increased. The question is, does it come all the way back up to the top of this, which would represent another, another 4% gain or so. I should say that historically in pre-election years, there is a trend around October or September to see some form of a correction in the S&P 500. This also has historically corresponded to Bitcoin dropping below its 20-week moving average in its pre-halving year. So we'll see if that manifests again. Again, normally it happens in that August-September timeframe. Again, if you go look at yield curve inversion, you can see there are a lot of similarities, right? 2019, pre-election year. 2023, pre-election year. 2019, yield curve inversion. 2023, yield curve inversion. 2019, we saw this parallel channel sort of break to the upside. Then we got a recession, and then we went to the bottom of it. Here, it's breaking to the upside again. Back over here, once it broke to the upside in November, it took 4 months or so for it to break back down. And this time we've only recently broken back above it, really like in the last month or so. So do remember that these things can take a long time to play out. Even if there is some form of a correction in August or September, it could just be back down here, only then it bounce back up again and continue going up. If you don't necessarily buy the idea that the S&P will often see a correction sometime in August or September of the pre-election year, that's probably a fair thing to sort of question. And so rather than just say that, why don't we just go take a look? Okay, so if we look up the S&P 500 year-to-date ROI, this is what it looks like, right? Tells you everything you need to know. Of course, I'm kidding, right? It's hard to know what's going on here. But if you look at prior pre-election years, let me show you where we are in 2023, there are often times where we get a correction in the S&P right around now, right? So maybe not July, right? But like as you get into that August-September timeframe, really August and maybe early September, we've seen a correction. Now you might say, well, Ben, this is just 2019. What are you talking about? Like, what about 2015? 2015 was, of course, a much more tempered version, right? We had a recession scare back then, and you can see over here, right, that the S&P sort of dropped off in that time frame, and you can go back even further. 2011, pre-election year, you can see the S&P dropped off around that time frame. 2007, you can see that it dropped off around this time frame. 2003, a little bit of a drop off, but not as significant. But rather than go through all of them individually, why not take the average, right? So take the average of 2019, 2015, 2011, 2007, 2003, and just for the hell of it, we can throw in 99, we can throw in 1995, we could throw in 1991, 1987, 1983, 1979, 1975, and 1971. Okay, that should give us a fairly decent approximation. Add that series to the chart, and let's see what's going on. So when you look at 2023 within the context of the last, 10 to 15 pre-election years, it looks something like this. And if you zoom in, it's normally around this time where you do see some form of a correction. And when I say normally around this time, I mean it typically doesn't actually occur until like early August. You can see the average here, though, is of course starting to sort of roll over in July. But sort of a more quicker move down occurs sometime in that August-September timeframe on average. So I do want people to be aware of that trend that we have previously seen. And the reason I talk about that is because if you follow this channel because you're interested in Bitcoin, we know that oftentimes in the pre-halving year, Bitcoin falls below its bull market support band in that August or September timeframe. Now, is it going to happen this time? Of course, this is a very big debate right now. But if you were to just look at say the bull market support band for Bitcoin, we know that the pre-halving years, which of course happen to correspond to the pre-election years, you will note that in 2019 we fell below the bull market support band in September. In 2015 we fell below the bull market support band in August, and in 2011 we fell below the bull market support band in August. Now, why did we fall below it in August or September each of these years? Why do I think? I think it's because I took it off the screen, but I think it's because, well, no, here it is. I think it's because we often see a correction in August or September by the S&P 500, a 5 to 10% correction. Now, remember, even though there's a correction by the S&P, typically in a pre-election year in August or September, more typically also after that correction, you see the S&P continue to go up in Q4. The reason that it typically doesn't go up is if people get overly concerned about a recession again. So if layoffs start to pick up, then you could see tempered returns even going into Q4, and perhaps it could go down just like it did in say 2015. If you remember, we were looking at 2015 earlier, and in 2015, while it went down and we went a little bit back up and a little back up in Q4, it more or less ended the year at 1, right? I mean, the year basically didn't accomplish anything. And that was because there was sort of a recession scare. Not that a recession materialized, but there was just a scare of one. And so that's one of the reasons why returns were somewhat tempered. But I think this is an interesting way to look at the chart. Bitcoin tends to drop below the bull market support band in August or September of its pre-halving year, because the S&P is typically having a correction in August or September of the pre-election year. We also know that the S&P likes to climb the wall of worry for the most part in the pre-election year. And in fact, it did the same exact thing in 2019, where the divergence of the S&P 500 and net liquidity were actually at fairly extreme valuations, just as they are today. And in fact, today, they're at more extreme valuations than they were back then. So it's interesting how we can tie all of this together. One more thing, just to throw one last thing in case this hasn't been enough. If you were to take a look at the S&P 500 divided by M2, you will see, in fact, that we are at levels on par with what we saw as the prior two tops for the S&P 500. Okay, now this would go to show, right, that like we are definitely at valuations that are getting somewhat extended. Doesn't mean that it has to, see a massive correction immediately, but this is previously where we turned back around in 2019. It's also where we turned back around in sort of that 2021 timeframe as well, and we're currently at those same valuations today. Now, there's another way to look at this as well. We could sort of connect the dots here and say, well, technically, maybe it's going a little bit higher each time. If that were the case, that would correspond to another move in the S&P 500 to the tune of approximately 3%. If the S&P went up another 3% and net liquidity were to stay the same, which it probably won't, but another 3 to 4% move would actually get you to the top of this channel, which is where it was back in February 2020. Note that there could be a path where the S&P goes down in August to September, rallies back up in Q4, only then it fall again in Q1 or Q2 of the election year, just like it did in the prior election year. Now, again, I understand that the pandemic is going to be called a black swan. But what if the yield curve inversion of 2019 told us the economy was sick? We didn't know, we don't know what was going to happen, but something happened, and then we went into a recession, and arguably the recession could have been a lot worse had they not printed a lot of money. I'm guessing that they'll just print a lot of money again when things get bad. And when we are at least seeing inflation come down, so when things do take a turn, perhaps the Fed will start to print, but I don't really think that's going to happen this year. It might happen sometime next year. Okay, so that's where we are. Hopefully this video is useful. I think that net liquidity is a really interesting metric for navigating financial markets, and you tie that in with seasonality with crypto and seasonality with equities, and I feel like it gives us a pretty good picture of what's going on in the markets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. You'll get access to charts like this one, as well as many other charts. We have thousands of charts on the website, not only for for cryptocurrencies, but also for equities, and we have macro charts as well. And we're currently building out more things. Thank you guys for tuning in. I'll see you next time. Bye.